Investing can feel hard. Markets go up, then markets go down. The news headlines can often scare you. Many people worry constantly that they will lose their hard-earned money, but I want to tell you that you can learn to be steady. You can become an unbreakable investor. This means you have a clear plan. You have a set of personal rules. You know precisely how to act when markets inevitably move. Most importantly, you do not let fear or hype break you from your long-term goals. An unbreakable investor is not someone who is always right, but someone who has a process that prevents them from being terribly wrong. What does it mean to be unbreakable? It means you have built a mental framework that can withstand volatility. It means you have separated your emotions from your financial decisions. Think of it like a pilot flying through turbulence. The pilot does not panic. The pilot does not suddenly change course based on a single gust of wind. Instead, the pilot trusts the instruments, follows the flight plan, and knows the plane is built to handle the stress. Your investing plan is your flight plan. Your principles are your instruments. Your mindset is your calm professionalism in the cockpit, guiding you safely to your destination. The first and most critical step is to shift your mindset. Many people approach the stock market like a casino. They treat it like a game of chance. They hope to get lucky and win fast. An owner, however, thinks very differently. An owner looks at the underlying business behind the stock ticker. An owner asks if the company makes products or services that people will still need in 5 years, 10 years, even 20 years. An owner does not get shaken by every news report or daily price swing. You must build this owner mindset. This journey is not about finding secret stock tips or a magic formula. It is about building a durable process. It is about cultivating a temperament that allows you to act with reason when others are acting with fear. Throughout this essay, we will break down the steps you can take to build this mindset and the practical tools you need to put it into action. We will move from big ideas to small, concrete steps. The goal is to give you the confidence to not just survive in any market, but to build wealth methodically over time, no matter what the headlines say. This is how you become unbreakable. Think of the stock market as a giant machine that builds wealth over time. It is not a slot machine. It is an engine of progress. They invent new products, they offer valuable services, they earn money by doing so. When you buy a share of a stock, you are not just buying a digital symbol on a screen. You are buying a small piece of that actual business. You become a part owner in that company's future success. Over many years, great businesses tend to become more valuable. This is the fundamental force that helps your investment grow. You do not need to guess the market's direction every single day. In fact, trying to do so is a recipe for failure. The real power comes from being patient. The wealth machine works slowly, but persistently. Consider a company that makes a popular brand of soda. Consider a company that makes a powerful computer chip. As long as people keep buying those products, the company keeps making money. It can then reinvest that money to create new products, expand into new countries, and return some of it to you as a dividend. This cycle of growth and reinvestment is what compounds your wealth over the long term. They see a stock price go up and feel the urge to chase it. They see a price go down and feel the panic to sell. They are reacting to the noise of the machine, not the fundamental work it is doing. The unbreakable investor understands that the daily price movements are often just noise. The weekly price movements are often just noise. The monthly price movements are often just noise. The real signal is the long-term health and profitability of the businesses you own. Your job is not to predict the noise. Your job is to select good components for the machine and let it run. So, how do you harness this machine? You start by accepting its nature. It is powerful, but not perfect. It will have good years. It will have bad years. There will be periods of great excitement. There will be periods of deep pessimism. Your task is to develop a good plan and stick with it through all of these cycles. By owning a collection of quality businesses, you are putting the powerful, long-term trend of human innovation and economic growth on your side. That is a much more reliable strategy than trying to outsmart millions of other people every single day. To build your owner mindset, you need a foundation. Here are 7 simple rules, pillars, to start with. They help you think and act like a business owner, not a speculator. Write them down. Keep them where you can see them. These aren't secrets. They're timeless principles used by the most successful investors. First, own quality. This is the most important rule. Buy excellent businesses, not just moving tickers. Look for products or services with a clear advantage. They sell something people want or need. They are led by management you can trust. Second, have conviction. Know exactly why you own a stock. Write down 1 or 2 key reasons. If you can't state the reason simply, don't buy. Third, respect risk. Every investment can lose money. Never assume a stock is certain to go up. Acknowledge risk upfront so you can prepare. Fourth, think in time horizons. Decide how long you plan to hold. Short-term needs. Keep those funds safer. Long-term money. Allocate to growth. Accept volatility. Fifth, diversify intelligently. Don't put everything into one stock, but don't own so many that your best ideas are diluted. A focused portfolio of 10 to 20 well-understood companies is often better. Sixth, use pullbacks wisely. Price drops in great companies can be buying opportunities. Only add if your original reason still holds. Seventh, stay teachable. Markets evolve. You will make mistakes. Learn from mistakes. Read. Study. Constantly improve your process. Where do you find these great investment ideas? The good news is that you do not need a fancy Wall Street terminal or secret inside information. Many of the best ideas come directly from your own life and your own observations. Think about the products and services you use every single week. Which company makes your smartphone? What brand of coffee do you buy? What software does your company rely on to do its work? You already have a unique circle of competence based on your job, your hobbies, and your daily habits. Start by being more observant of the world around you. Notice which stores are always busy. Pay attention to which brands your friends and family are excited about. Do you see a new technology or service that is rapidly changing how people do things? Perhaps you notice more local businesses using a specific payment processor, or all the kids in your neighborhood are obsessed with a new gaming platform. You can also look at big, durable trends. The global population is aging. That creates long-term demand for healthcare services and medical devices. The transition to clean energy is another massive trend requiring huge investment. The increasing digitization of our world. Cloud computing and artificial intelligence. Look for well-run companies positioned to benefit as these trends grow stronger over the next decade. The key is to turn these observations into research. An idea is just a starting point. If you see a busy store, find the name of the parent company. Then investigate its financial health and growth prospects. Combine your real-world insights with basic financial homework, and you can uncover investment opportunities hiding in plain sight every day. Once you have an idea, you need a way to screen it. You need a simple, repeatable process to separate good ideas from bad ones. This filter helps you avoid emotional decisions. Focus on the fundamentals. Before you ever consider buying a single share of a stock, you should be able to answer these 6 basic questions. If you cannot find clear and positive answers, it is often best to simply pass on the idea and move on to the next one. This discipline is what protects your capital from speculative bets. First, do I truly understand this business? If you cannot explain what the company does and how it makes money in a few simple sentences to a friend, you should not invest in it. Avoid companies with overly complex business models or technologies you cannot grasp. Second, is the company's revenue growing? You want to see a consistent track record of the company selling more over time. Third, are its earnings improving? Revenue is important, but profits are what ultimately matter. Look for net income or EPS on an upward trend. Fourth, is the balance sheet solid? You want to avoid companies drowning in debt. Prefer more assets than liabilities. A strong balance sheet gives flexibility. Fifth, is the market opportunity still growing? Is it a large and expanding market or a shrinking industry? Sixth, am I buying for strength, value, or a turnaround? Know your reason. Knowing your thesis helps you know when to sell later. Now, let us talk about how to put these ideas together into a simple portfolio. A good portfolio is not just a random collection of stocks. It is a thoughtfully constructed team of investments where each part has a specific job to do. You can think about this using a bucket system. Core, growth, income, index, cash. This approach helps ensure you have a balance of growth, stability, safety. A well-built portfolio is designed to be resilient. It should not depend on you being a perfect stock picker. Its structure is what helps you survive your own mistakes. Your first and largest bucket should be for your core holdings. These are your all-stars, large, dominant, stable companies with a proven track record. Because they are less volatile, allocate the largest portion here, perhaps around 40%. Next is your growth holdings bucket. Younger innovators with higher upside and volatility. Keep these positions smaller, about 20%. Then, you have a bucket for income and stability, dividend payers, consumer staples, utilities, bonds, and other fixed income assets, maybe 15%, acting as a shock absorber. We also add broad market ETFs, about 10%, to ensure diversification, and a crucial bucket for cash, around 10 to 15%. Cash gives you safety and the ability to buy when opportunities arise. While stocks are a powerful engine for wealth creation, stocks are not the only tool available to an investor. A truly unbreakable portfolio often includes different types of assets, each chosen to perform a specific role. Using the right tool for the right job is a mark of a skilled and thoughtful investor. Exchange-traded funds, or ETFs, are an excellent tool for diversification. An ETF allows you to buy an entire basket of stocks or bonds in a single transaction. For example, you can buy an S&P 500 ETF, which gives you ownership in 500 of the largest companies in the US. This is a simple and low-cost way to ensure you are not overly concentrated in just a few individual companies. ETFs can be used for your core holdings or to gain exposure to specific sectors, like technology or healthcare, without picking individual winners. Bonds are another critical component, especially as you get older or if you have a lower tolerance for risk. They pay regular interest and are generally safer, helping cushion downturns. Finally, think about other assets like real estate, directly or through REITs, which can provide both income and growth. And never underestimate the importance of cash. Holding cash or T-bills gives you two things: safety and opportunity. It is important to understand the bigger forces that can influence the market. These are often called macroeconomic factors. The most powerful of these is the central bank. In the United States, that's the Federal Reserve, or the Fed. The Fed's decisions on interest rates and the money supply can dramatically change market mood and direction. Understanding this context helps explain market behavior, but it shouldn't drive your individual investment decisions. Think of interest rates as the price of borrowing. When the Fed raises rates, borrowing gets more expensive for companies and for consumers. That tends to slow the economy to fight inflation. Higher rates can make riskier assets like growth stocks look less attractive versus a safe government bond. When the Fed lowers rates, borrowing gets cheaper. That encourages spending and investment, often pushing investors toward riskier assets seeking higher returns. Inflation is another major macro force. It's the rate at which prices for goods and services rise and purchasing power falls. High inflation can erode your savings and future company profits. The Fed's main job is keeping inflation under control, so it raises rates when prices rise too fast. As an investor, own assets that can outpace inflation over the long term, which is a key reason people invest in stocks. Be aware of the environment, but don't let it rule you. Do not try to be a macro forecaster. Use macro info as context. Keep your focus on the long-term health of the businesses you own. A good investor knows the critical difference between conviction and emotion. Conviction means you have a clear, logical reason to hold a stock through its ups and downs. Emotion is when you react to a scary headline or a plunging stock price with fear. The single biggest challenge for most investors is learning how to master their emotions and act with discipline, especially when things get difficult. Learn from the discipline taught by legendary investors like Warren Buffett. The general rule is to hold on to your great companies through the normal market cycles. Do not sell a wonderful business just because of a frightening news report or a 10% market correction. However, discipline does not mean you should hold on to a broken business forever. You should sell if your original reason is no longer true, if a company loses its key advantage, if new technology makes its product obsolete, or if management makes consistently poor decisions. Consider selling if revenues and profits are falling for multiple quarters with no end in sight. To build this discipline, practice with scenarios. If a core stock drops 20% on market fear, hold or buy more. If a growth stock drops 30% after earnings, investigate or panic sell. If a stock doubles, trim to rebalance or let greed take over. Answer now with a clear head. We have covered the mindset, the principles, the process. Now it is time to put it all into a simple, personal playbook. This is your guide. Following these steps will help you build discipline and make better decisions over the long run. The goal is to create a repeatable process that you can rely on every time you invest. This plan turns you from a passive worrier into an active, confident owner. It is your path to becoming an unbreakable investor, starting today. Here is a small homework plan you can do right now. This is not theoretical, it is about taking action. This will help you solidify your new identity as an investor. Part 1. Define your investor identity. Take out a piece of paper or open a new document and answer these 3 questions honestly. What kind of investor do I want to be? For example, conservative focused on capital preservation, balance seeking growth and income, aggressive aiming for maximum long-term growth. What is my time horizon? What are my emotional weak points? Do I get scared easily? Do I chase hot stocks? Do I get impatient? Part 2. Build your initial watch list. You are not buying yet, you are just looking. Pick 5 companies you know and understand from your daily life. For each stock, write down what the company does, one simple reason it might be a good long-term investment, the single biggest risk to the business. Part 3. Draft your portfolio blueprint. This is your ideal plan. You do not have to build it overnight, just map it out. Based on the bucket system, decide your target allocation. Set a rule, no single stock more than 10%. If you complete this homework, you will be far ahead. You will have a plan, rules, a process. You will make fewer unforced errors and learn from those you do make. That is the essence of compounding. It is not just about money, it is about knowledge and discipline. The unbreakable investor is not someone who is perfect. They learn, adapt, and stick to a sound process again and again. Your next step is simple. Write it down, make the plan, be steady, be patient, be an owner. The unbreakable investor is not the one who never gets hit. It's the one who keeps learning, keeps compounding, and refuses to let emotion destroy the plan.